There is a mix of things that push people toward investing. And this mix is exactly what usually leads them to make mistakes. The biggest mistakes of all is believing that your daily actions, checking your portfolio, moving things around, reacting to the market, are what will change the final outcome of your investments. And that brings us to today's question. Which emotion destroy investments the most? Welcome friends, I'm Fred. Here we talk about investment, business, real life and training, all from my personal perspective. When you start investing, it's very easy to believe that you are the key variable, that you can make a difference by being active, reacting faster, by making smarter moves than everyone else. And that belief is extremely dangerous because the truth is simple. What destroys investments more than anything is not staying invested. Let me explain. If you look at almost any long-term chart of Brazilian stock market or American stock market, what do you see? You see volatility, yes. You see crashes, corrections, crises. But you also see something else, a long-term upward trend. If someone had stayed invested since 1995 or 2001 or even 2005, their wealth would be multiple times larger today. That's just a fact. So, the real question is, why can't most people simply stay invested? Because they believe they can do something extra. They believe they can actively improve results through constant action. They stop thinking like investors and start thinking like speculators. I was recently discussing options, strategies, reading some books I have at home, and I asked ChatGPT a simple question. Is it possible to create a relatively safe option strategy that performs well over time? The answer was yes, it's possible. But then came the important part. The expected return wouldn't be spectacular. Maybe something like 5% per year with conservative strategies. And honestly, that sounded very realistic. The problem is that most people don't want 5% per year. They want 5% per month. They want to multiply their money quickly. They want a financial miracle, not financial stability. But here's the reality. If you multiply your wealth over decades, not months, that's already enough to build financial peace. We should aim for financial tranquility, not miracles. So, answering the question directly, the emotion that destroys investments most is anxiety, combined with overconfidence. The belief that you can control short term outcomes. This reminds me a lot of combat sports. In martial arts, beginners often think they can fight. They believe they will do fine. But the first time they step into the ring with someone experienced, reality hits hard. They realize they don't even understand what's happening. The same thing happens in the market. To be minimally competent as an investor, the strategy is boring. Buy good assets, Buy consistently. Stay calm. Do nothing most of the time. And that's it. Let me give you a practical example. Right now, part of my strategy is buying US ETFs. I know that in the short term, this strategy underperformed Brazilian fixed income. Brazilian interest rates are high. Fixed income looks very attractive, but my ETF strategy is long term. It's about dollar exposure. It's about reducing Brazil specific risk. It's about being exposed to the largest market in the world. So, I don't look at prices. Every month I buy, no matter what the market did, no matter if prices are up or down. That's the only way to remove emotion. Because if you believe you can optimize results by timing the market, you will lose. Your emotions will always win. Humans are not robots. When prices fall, fear kicks in. When prices rise, greed kicks in. And both emotions lead to bad decisions. You will start chasing performance. You switch strategies constantly. 1 month, you are in stocks. Then, interest rates go up, and you move everything to fixed income. Here in Brazil, for example. Then, stocks rise, and you jump back in. Late. You go back and forth. And sometimes people say, well, maybe rotating between fixed income and stocks works. Maybe. But only if done slowly, over many years, not weekly, not monthly. And even then, most people miss the best moments. They enter stocks after prices already went up. They leave stocks after prices already went down. So, in practice, even this strategy often outperforms simple consistency. Often underperforms simple consistency. That's why I increasingly believe the best approach is this. Define a percentage for fixed income. Define a percentage for equities. Stick to it. Rebalance calmly. Do not react emotionally. This removes the illusion that you can outsmart the market. Because trying to beat the market emotionally usually leads to one of two outcomes. One, you lose money and try to recover it by taking more risk. Or two, you give up completely and say the stock market is a scam. Both are bad. Ironically, even staying only in fixed income is better than emotional investing. But the real goal is balance. The foundation of everything is simple. Avoid debt, invest consistently, stay invested, and that's it. In my case, my main investments were real estate. And thankfully, that strategy has worked for more than 20 years. Not because I was smarter than the market, but because I stayed disciplined. So, to close, the emotion that destroys investments the most is the belief that you need to constantly act. The belief that activity equals intelligence. It doesn't. In investing, inaction is often the smartest move. Acting is not the smartest move. Tell me in the comments, my friends, which emotion do you think destroys investments the most? Thank you for watching, and I see you in the next video.